types of crypto investors are actually taxed. From long-term holders to active traders, your tax obligations can vary significantly based on your investment strategy. Now, Jashwin, will you help us break down the different types of investors and tax implications for each? Now, let's start off with long-term investors. A long-term crypto investor is someone who holds onto crypto asset for an extended period of time, anticipating long-term growth. These investors are generally taxed on capital gains or losses. Now, could you explain how long-term crypto investors are actually taxed? Perhaps drawing a comparison to the tax treatment of shares, a more familiar asset class.
So there is discussion of the holding. So you'll know with shares, there's obviously that 3-year rule, right, which determines it. Now, a share is typically acquired with the intention of holding it as a long-term investment. With crypto, it's a little bit different, and it is more of a factual inquiry than anything else. So yes, there is the acquisition with capital intent, which is all good and well, but it is then a case of what's your transactional frequency like? You know, as Vian mentioned, if you're moving it from a platform to a cold wallet, as an example, that's not a taxable event. It's the same as, Christo, if you took money out of your current account, put into your savings account, and saw say, hey, gross income times 2. And mind you, they're doing that. Unfortunately, we've seen many orders. I see Vian having a good chuckle there. He's seen a good couple of those as well. Where you've got to detail transaction by transaction SARS. This is why you've duplicated. It's not gross income, and much the same with your crypto. So your differentiating inquiry is always factual, and it goes one of 3 ways actually. You've got, on the one hand, confirmation that, listen, this is an asset. By all means, you've held onto it for ages. You've never traded. There's been nothing. It's not even been staked. And then on the other hand, it's, well, you bought 5 Ethereum. You've transacted over the last 5 years with 2.5 of them. The other 2.5 has stayed. And then working on your first in, first out principle, you'd have an apportionment where half goes capital and half goes income. It's akin to trading stock, just based on your transactional frequency. And then on the furthest side, you've obviously got, you bought your 5 Ethereum and you've transacted with all 5 on and off on an ongoing basis over the last 5-6 years. Maybe 0.5 has retained its original characteristic from that first acquisition. But for the most part, it's akin to trading stock, and you would then tax at your marginal rate under other income.